3M is a dividend king that has increased its dividend for 64 consecutive years, making it one of the most powerful dividend growth stocks in America. Currently, the stock yields just over 4.75%, which makes it very attractive. This is the normal price to EBITDA that the stock has traded at going back to the beginning of 2002. And you can see that every time the stock has traded below its justified or normal market price to EBITDA of 11 times earnings, these were great times to buy the stock. Today, the stock is trading at a blended price to EBITDA of 7.65, indicating it's almost trading at half its normal value. Hello, everyone. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And, as a value investor, I'm always looking for value when I'm investing. I like to buy bargains. I like to find investments that I feel I can buy at below their intrinsic value, which gives me what I call financial leverage, and it also mitigates risk. It gives me a level of margin of safety. I do have small positions in 3M currently. I've decided to hold those. I'm going to go over why in this video. But the reason I'm doing this video was requested by viewers of the YouTube channel here as one of the most requested revisits, because I covered this in previous videos a couple of times before. And so I want to go through 3M. I'm going to give you the good, the bad, and the ugly of the stock and talk about why I've made the decision currently to continue holding the stock. And I'll be watching it closely with basically a bias towards wanting to add to this stock at these discounted prices. Because I do want to remind you of something. You don't find bargains in stocks that are popular, and you don't typically find bargains in stocks that are hitting, essentially on all cylinders. You find bargains when there's some issue, some catalyst that has spooked the market or brought the stock value down that could be a threat or might not be a threat depending on, how everything pans out in the future. So I'm going to get into the risk-reward ratio of investing in 3M today. And I also want to make another point. This is an income vehicle, and I've chosen to invest in it myself for the income potential. And as such, I'm intending to own this stock for a long, long period of time. I don't intend to sell it over the next 5, 10, or 15 years or more, based on the fact that I'm buying it for the steady and consistently rising dividend that the company has historically produced. Now, as Adam Smith once said when he was questioned about, changing his mind on certain things in economics, he said, when the facts change, I change my mind, sir. What do you do? So I always reserve the right to change my mind, because the only thing certain about the future when you're investing in common stocks is the uncertainty of it all. And so it's very important to continue to do your research and continue to do your due diligence, and then try to weigh those things according to your own risk tolerances and investment objectives. Those are very, very important principles. So let's go into the FastGraph research tool. And by the way, I highly recommend, as I'm going to illustrate here, there's so many powerful aspects of using this tool to really give you a perspective on what the business that you're investing in has performed, how the market has historically valued it, what its dividend growth was. You can easily do back testing and calculate performance with it. It's just such an efficient way to be looking at stocks. Let's go ahead and look at 3M Corporation. Now, starting out, I like to look at different metrics. Typically, I like to look at operating earnings. And there's one thing that strikes me here when I'm looking at 3M from an operating earnings point of view. If you look at the company historically, the blue line is the normal PE ratio that the market has typically applied. This is going back to the beginning of 2002. Now, notice that the market generally prices this thing at 20 times earnings or higher. Now, going into the recession, the PEs got down into this, 10 range, even the single-digit range. And then they stayed fairly valued for a couple of years after that. And then they went back to the old ways of being overvalued and are, trading at this higher valuation, normal market value of around 20 times earnings, 19 to 20. Remember, these numbers should always be thought of in terms of ranges. And then recently, the company's been going through some litigation. There's some supply, channel issues, some foreign currency issues, and so on that the company's facing. That's caused a weakness in the company's reported operating earnings. But I do want to make a point here. The company is not at this stage looking like it's going bankrupt. It is an A+ rated company It has a very strong balance sheet. It has over a $70 billion market cap, and it has a lot of things going for it, but it also has some negatives, and I'll try to cover all of those. Now, as a dividend aristocrat and dividend king, actually, with a streak of 64 years of increasing its dividend, I always like to look at the all-important operating cash flow. And you can see the company's been consistently generating cash flow that is much higher than the dividend, which is the white line in this graph. And even though cash flows are expected to be dropping last year and perhaps this year, they are expected to recover in the future by the analysts following the stock. And you can learn that by going into the forecasting graph. So you can see that the drop in cash flow has caused a strong price reaction to the stock. But cash flows are expected to start rising again. I'll give you some reasons why here in a few moments in the video. Now, even the more important factor is free cash flow, which is what's left over after spending, everything it takes to run the business. And I want you to note here that the company tends to trade at a high multiple of free cash flow, which I don't like free cash flow for a valuation measurement, although it can be used. When you see it trading at one of the lowest free cash flow values that it has in the last 2 decades, that should give you some indication that the valuation is high. Now, I can also use my dividend yield overlay, and I can also clearly see, this was a dividend yield of 3.3%. We are now looking at a dividend of 4.77%, which is another indication, another valuation indication that the stock is trading at a low valuation based on history. Of course, everything has to do with what the future holds. In the opening part of this video, I went and I looked at, what the company traded at in terms of its normal EBITDA. Now, we only calculate the normal EBITDA, which is actually the market EBITDA. In other words, how has the market typically valued this company over a long period of time? And you could see around 11 times EBITDA is what this orange line represents, and that's been historically the norm. The company now trades at a blended price to EBITDA of about 7.65, which is obviously a big discount, creating what appears to be a strong margin of safety if these forecasts turn out to be true. Okay, and as I stated, we'll get into that. And the forecast for the cash flows, and EBITDA is a soft form of cash flow, earnings before interest, taxes, depreciation, and amortization, for essentially its operating cash flows. It looks like there's some positivity here by 15 and 14 analysts that follow the company. Now, the last thing I want to look at is sales. The company has also historically grown its sales at an attractive rate of about 5.25% and expected to continue to grow at 4 or 5%, according to management's guidance and a lot of analysts' estimates. And the company is trading currently at a blended price to sales of about 2, and we are assuming that sales will continue to increase. So now this leads us into the question, why is the stock so cheap? I mean, clearly the stock is trading at a significant discount to what has historically been fair value or intrinsic value of the company. So what are the issues? Well, to learn what those might be, you can always go into the external links here that FastGraphs offers their subscribers. Now, some of these you have to actually pay for the subscription to get the full measure of what they offer, but you can go into sites like Seeking Alpha Research. And Seeking Alpha is a kind of a crowdsourced platform. And there was an excellent article written by James Long here, 3M, Upending Woes or Buying Opportunity. And he addresses this and he covers a lot of very important factors about the company. Now, he starts out with the big thing everyone's worried about is the company's currently facing litigations that could potentially bankrupt the company. I would have to say, yes, that could potentially bankrupt the company, but I don't think that's going to happen for a lot of reasons. And we'll kind of get into some of those. And then it also, he talks about, reasons, theses for selling the stock, holding it, or buying more. And then he also talks about the risk-reward opportunities of the current valuation. So he has a lot of good stuff in here. One of the things that he points out is their patents. You have to consider that this is a very, very powerful company, and you can directly link to their patent insights. And here you can see how many patents the company has, how many they file every year. And that's one of the real strong factors for this company is they have, over 21,000 active patents currently. And then he goes into their website. He looks at their ubiquitous products. And if you go through this, you can just see all the products the company has. And, you can go through page after page of all the different products that 3M offers. So this is not a one-trick pony. It's an extremely diversified pony. And like the company says, they rely on science. Now, he does come down here at the bottom, and he does draw some conclusions for himself. And I think that's important for you to do that for yourself. And his conclusions are that, the current litigations are definitely casting a pall over this company. And if these concerns are not giving you peace of mind, outlined in his 6 reasons to sell, so he does give you the good, the bad, and the ugly, then selling is definitely your prerogative. Now, he says that, but if you have full confidence in 3M, James says, and it's a great deal at the current valuation based on PE ratios, price to sales, and other metrics that I've shown you here, you can also consider buying 3M. I wouldn't be too anxious to buy 3M right now, but I am holding what I have bought, and I am, as I said, biased towards the idea that I would like to buy more, assuming these things don't pan out to be a lot worse than I anticipate. Okay, so I would recommend going into James' article here on Seeking Alpha and read it. It's a very excellently done article, and he does cover the good, the bad, and the ugly, which I like. You can also go into Yahoo Finance, and there are several research articles you can get out of Yahoo Finance that I think are also excellent. And, additionally, I think one of the real important things here is that through FastGraphs, you can go directly into the company's corporate website. And I've done that here. I've gone into investors, and I've gone into their recent slide presentation. And there's some, factors for you to mull over and contemplate. 3M is taking significant actions to benefit their stakeholders, their stockholders. They're creating value through a spinoff of the healthcare. That's coming up later towards this year. Maybe even into next year. They're taking action to resolve the litigations that are going on. So they are, working on that, and they are fighting many of these lawsuits. I think they will have liabilities for the lawsuits, but I don't think those liabilities, I personally think they're overblown. Corporations go through these kind of lawsuits all the time. Think Johnson & Johnson and many other cases where high-quality companies have been sued and end up paying big damages. They are also stating that they have delivered in a challenging environment. They have sales of $8.7 billion, organic growth of 1%, and the adjusted earnings of $2.48, and then they lowered their estimate down to $10.30 to $10.80. These are adjusted operating earnings. On the FastGraphs site, just to put that into perspective for you, if you go into the adjusted operating earnings metric, you see we've got estimates at 1040. That's just a little over the low side, so it's kind of a conservative estimate, and this could be as high as 1080, depending on what actually happens. From a standpoint of how forecastable this company has been, the company has one of the most stellar analyst scorecards that I've looked at. Just really was COVID was the really only major blemish when they were doing forecasts 1 year in advance, and again when they were doing forecasts 2 years in advance. It was one of the major times that they did miss earnings estimates, and there were obviously a lot of reasons for that. So the company is, giving you decent guidance. The forecasts are followed by 21 analysts. Now, I do want you to notice that, the analysts are forecasting lower numbers for the company than they were previously lowering, but it was $10.79 just 3 months ago. It's now down to, 1030 to 1080. So we got 1040 on here. And they're looking at a 5% growth the following year and another 4.5% to 5% growth in the next year. And this would give you some very high rates of return if the stock traded at a more normal price to earnings ratio of 15. If it traded at its typical 20 multiple, then again, the rates of return can be very, very high here. So let's get into how the company is going to handle some of these lawsuits and some of the other issues. Now, I subscribe to Morningstar. Morningstar gives the company a fair value of 183. I think they're saying roughly 18 times this year's earnings estimate. The company's trading at 124, so they consider it undervalued. They consider a 5-star price, which would be a screaming bargain, at 109, and it's currently trading at 124. Now, also, Morningstar talks about a lot of the risks, and they are pointing out that there's uncertainty in the stock right now. So this is an extremely high-quality company with a very strong balance sheet, enormous patents, great product lines, great science, but the company is going through some challenges with this litigation. And so that's something you can go ahead and read this research more carefully yourself and, learn more. You have to follow your own judgment here. You have to follow your own heart. My judgment is I think this company will prevail. I don't think they're on the verge of going bankrupt. They are an A+ rated company. They do generate very strong cash flows, and I think they have the resources and the management team that'll be able to go through this litigation challenge, over the stock. But as Morningstar points out, these litigation fears hover over the stock. And again, that's a reason why the price is so low. Those risks, I believe, are already priced into the stock. You have to decide that for yourself. Morningstar believes this company has a wide moat based on intangible assets and cost advantages. Again, it has over 20,000 patents, in its thing. Now, there are other places, as I mentioned, you can go into Yahoo and look for research. I also subscribe to Zacks Investment Research, and I do like Zacks because they give you reasons to buy, and they talk about all the reasons why the company is, in a position to continue prospering and going forward. They talk about the fact that, this company is probably sustainable for the next 20 years, but they also give you reasons to sell, and they talk about competition, foreign currency headwinds, which have been a big impact on the stock's recent weaknesses. They also talk about, the litigation and so on. And again, they give a pretty glowing report. And, they said adjusted earnings per share of 10.30 to 10.80 compared to 10.75 to 11.25 that they anticipated earlier. And they think operating cash flow is expected to be $6.6 to $7 billion. So all in all, what you've got here is a company that's, going through some challenges right now. That's why the stock is cheap. A company, Capital.com, they do talk about 3M's, what they call a hearing problem, which is litigation for the hearing aids. Now, this was on a company they acquired in 2008 that sold most of the hearing aids were sold prior to them owning it. But it is now they do carry that liability as happened to other companies in the past. But they point out that the company is trying to unlock value in different business lines. They've mentioned that 3M is embroiled in a series of legal cases involving earplugs to the U.S. military from year 2000 to 2015, tens of thousands of individual lawsuits. And they say the total number of plaintiffs involved could top up to 200,000. But they do add that 3M has taken a path similar to other large companies facing substantial liabilities over a minor product line. It has announced the spin-off, which promptly commenced Chapter 11. I think that's been denied by the courts, however. But, it does give the point that, I think there's probably going to be settlements involved here rather than, continuous litigations. So the bottom line is, I think if you look at 3M and weigh all the factors, you do have to make some conclusions. Number one is the company still is positioned to grow in the future. They are going through, a down period. That's not the first time that's happened to the company. The stock has gotten extremely inexpensive relative to historical norms. If you look at, any of the valuation measurements that you would typically value a stock with, you would consider it to be cheap by any standards. Now, we can also go into the health check here and look at, things, the company's return on equity has been really better than the industry average. I think that's really important, compared to its total equity. The company has had total equity of $15.1 billion, and their net income has been $5.9 billion for last year. So the company has a lot of positives going for it. They do generate generally very good margins above industry standards, you can see by our health check here. So, going on and on, what I'm suggesting to you all is research the stock deeply. I think this video has gone on far enough. My own conclusion is I have a small position in my money management firm in the stock, less than $1 million. I plan to hold that position with a bias towards adding more to it once I get a little more clarity. But I think the dividend is currently safe. The company's committed to the dividend. They just recently announced their dividend. They've obviously got a long dividend streak. The company's paid dividends for over 100 years and increased it for over 64 years. So that's, a pretty good record. The company does have a wide moat. It does have hundreds of product lines. I think almost 1,000 different products. There's a lot of aspects to this company that will be performing well in the future and generating good cash flows. So all in all, I consider this a wait and see stock right now. I would actually consider it a buy here for the aggressive investor. For the more prudent investor, I would, watch it very closely. And what I'm talking about watching is I don't react to the stock price changing. I look at the stock price as either being too high to interest me or buy, or I look at the stock price as being an opportunity or a potential opportunity. But I always recognize that when you get opportunities like this, especially in high quality companies like 3M, there is usually a reason. In other words, this doesn't just happen, arbitrarily. There has to be some reason. The company does have some problems, obviously. I think management's up to the challenge. They have raised their payout ratios recently. I think that's something to also focus on. They're kind of committed to their dividend. Until that changes, I'm content to continue to hold the stock. And keep in mind, this represents one holding in an overall diversified portfolio, and you should always be thinking that way. But the risk-reward ratio here, I think, is very, very high. Anyway, this has been Chuck Harnevale, just bringing you an update on 3M, trying to give you some of my feelings about the company. I do consider this a very high-quality company. I've faced this with companies with names like Johnson & Johnson and many others that have faced, serious litigations. You remember the talcum powder with Johnson & Johnson. That company survived beautifully. I think 3M will survive. I think they got the resources, the balance sheet, the market cap, the cash flow generation. I think the company will be fine long term, but at this point, it is going to require some patience. I don't necessarily see this company screaming to the upside. Most analysts, by the way, are giving it a hold rating, and I would be in line with that. If you like this video, give me a like, ring the bell, subscribe to the channel, and take a look at FastGraphs. What a great research tool. I wouldn't consider investing in stocks without it. And we got many, many improvements coming down the pike, and some of those very, very soon. Anyway, thanks for watching.